Imagine turning $100 into more than $100 billion, not through luck, not through flashy startups, but through patience, discipline, and an obsession with understanding how money really works. This is the story of a man who read hundreds of annual reports for fun, who bought a dying textile mill and transformed it into one of the most powerful financial machines on the planet, and who built an empire by following one simple rule: be fearful when others are greedy, and greedy when others are fearful. Today, we're diving into Buffett, the making of an American capitalist, the definitive biography that reveals how Warren Buffett became the most successful investor in American history, and, more importantly, what you can learn from the mindset behind his fortune. Warren Buffett didn't become the Oracle of Omaha because he was born rich, had political connections, or stumbled into a lucky break. Roger Lowenstein's book shows us something far more interesting. Buffett became Buffett because he mastered the psychology of money long before he mastered investing. This biography takes us from a young boy obsessing over numbers in Omaha to a Wall Street outsider who reshaped the entire culture of American capitalism. And along the way, it exposes the principles that made him unstoppable. For example, as a kid, Buffett wasn't playing baseball or hanging out with friends. He was running paper routes, buying pinball machines, tracking penny profits, and reading every book on business he could find. He learned early that money compounds, but only if you respect it. That mindset became the foundation of his empire. The book reveals the moment that changed everything, discovering Benjamin Graham. Graham didn't just teach investing. He taught a worldview, the idea that stocks aren't lottery tickets. They're pieces of real businesses. And Buffett took that philosophy and elevated it to an art form. He wasn't hunting for excitement. He was hunting for value, for durability, for human behavior, for companies run by people he trusted. The magic of Buffett's rise isn't just the deals he made. It's the discipline he kept while the rest of the world chased quick wins. When the go-go era of the 1960s sent investors into a frenzy, Buffett stepped back. When the market crashed in 1974, he stepped in. When Salomon Brothers nearly collapsed under scandal, he walked into the fire and rebuilt trust from the inside out. Lowenstein paints Buffett not as a legend, but as a man who understood one truth better than anyone. Success in money isn't about IQ, it's about temperament. It's about staying calm when others panic, thinking long-term when others want instant gratification, and being relentlessly curious about how businesses and people really work. By the end of this summary, you'll understand the habits, decisions, and philosophies that shaped America's greatest capitalist, and how you can apply those same principles to your own financial journey. So let's dive in. Chapter 1 introduces Warren Buffett's early environment and the factors that shaped his financial mindset long before he became a legendary investor. Omaha in the 1930s was a modest Midwestern city, rooted in practicality and conservative values. This backdrop matters because it's where Buffett absorbed the ideas of thrift, discipline, and quiet ambition, themes that would define his entire approach to money. Buffett's father, Howard Buffett, was central to this foundation, a stockbroker turned congressman. Howard was principled, deeply conservative, and skeptical of debt and government intervention. Growing up under a father who believed in personal responsibility and financial caution gave Warren a worldview built on independence and analytical thinking. Meanwhile, his mother, Leela, brought strict frugality to the household, especially during the hardships of the Great Depression. Warren saw firsthand how economic fear could shape behavior, and this early exposure made him sensitive to risk and deeply curious about how money worked. From a young age, Warren displayed unusual numerical talent. He memorized baseball statistics, calculated odds for fun, and became fascinated with the idea of compounding. His early business experiments selling gum, delivering newspapers, and tracking every penny showed a child already studying profit margins and efficiency. The book makes it clear Buffett wasn't gifted with wealth. He was gifted with an instinct for value. Chapter 1 also highlights how isolation from the financial centers of New York helped Buffett develop an independent mindset. Without Wall Street noise, he learned to think for himself, a trait that later allowed him to make contrarian investment decisions. Overall, the chapter sets the foundation. Buffett's success didn't begin with brilliant investments. It began with a Midwestern upbringing that shaped his temperament: rational, disciplined, curious, and obsessed with understanding money at its core. Chapter 2 explores Warren Buffett's early adolescence and shows how his interest in money evolved from small experiments into a clear, measurable drive for wealth. The chapter emphasizes that Buffett wasn't simply curious about business. He was obsessed with finding ways to accumulate capital, track his progress, and reinvest every dollar he earned. During this period, Buffett became increasingly independent. He ran newspaper routes that generated steady income, and the book details how he approached the work with efficiency and analytical thinking. He mapped out delivery paths, optimized time, and kept meticulous financial records, behaviors that signaled both discipline and an early investor's mindset. This wasn't just a teenager earning money, it was a teenager building systems. The chapter also explores his growing fascination with the stock market. At age 11, Buffett bought his first stock, Cities Service Preferred. The experience was formative. He watched the price drop, panicked, then sold after a small rebound, only to see the stock soar later. Lowenstein uses this story to illustrate Buffett's first lesson in patience, volatility, and long-term thinking. It would become one of the core principles of his future investing style. Buffett's adolescence also revealed his tendency to operate outside conventional expectations. While other kids focused on social activities, Buffett spent hours reading financial tables and hunting for ways to grow money. The chapter highlights how this runaway independence separated him from peers and foreshadowed his later refusal to follow market trends or Wall Street fashions. By the end of Chapter 2, the reader clearly sees a pattern forming: Buffett's early drive, his willingness to work relentlessly, and his growing conviction that money could multiply if managed intelligently. These traits formed the backbone of the investor he would become. Chapter 3 covers the turning point in Warren Buffett's intellectual development: his discovery of Benjamin Graham and the formal structure of value investing. This chapter explains how Buffett moved from curiosity about markets to a disciplined investment philosophy grounded in logic, margin of safety, and intrinsic value. Buffett first encountered Graham through The Intelligent Investor, a book that immediately reshaped his thinking. Lowenstein describes Buffett as recognizing, almost instantly, that Graham's framework matched the way his mind naturally worked. Graham treated stocks as part ownership of real businesses, not trading chips, a perspective that deeply resonated with Buffett's analytical temperament and his preference for predictable patterns over speculation. This chapter also explains Buffett's decision to attend Columbia Business School, specifically to study under Graham. In Graham's classroom, Buffett wasn't just learning theory. He was absorbing the mindset of a man who viewed the market as a voting machine in the short run, but a weighing machine in the long run. Concepts like intrinsic value, statistical bargains, and emotional discipline became the foundation of Buffett's future investing style. Lowenstein highlights Buffett's admiration for Graham, bordering on reverence. Graham was the first person Buffett fully trusted for financial wisdom, and Buffett adopted many of Graham's habits, including rigorous analysis and an aversion to unnecessary risk. However, the chapter also signals that Buffett would eventually evolve beyond his mentor, particularly by seeking high-quality businesses rather than just cheap ones. By the end of Chapter 3, the key takeaway is clear: meeting Benjamin Graham, intellectually first, then in person, provided Buffett with the structure, confidence, and methodology he needed. Graham gave him the blueprint for rational investing, the discipline to ignore market emotions, and the belief that long-term value could be measured and captured systematically. Chapter 4 describes Warren Buffett's transition from student to professional, marking the phase where he started applying Benjamin Graham's principles in real investment decisions. The chapter focuses on Buffett's early career after Columbia and his first attempts to enter the financial world on his own terms. After graduating, Buffett wanted to work directly for Graham Newman, Graham's investment firm. However, his initial request was rejected. Lowenstein notes that Buffett returned to Omaha disappointed, but not discouraged. While waiting for an opportunity, he worked for his father's brokerage, where he began analyzing companies with Graham-style methods. This period became Buffett's first practical laboratory for value investing. He studied obscure, thinly traded companies and developed a habit of digging through financial statements that most investors ignored. A pivotal moment came when Graham finally offered Buffett a position. Moving to New York, Buffett worked under Graham in an environment that was deeply systematic and unemotional. The firm sought statistically cheap stocks and distressed situations areas where market inefficiency could be exploited. Buffett thrived in this setting. He learned how to build diversified portfolios of undervalued securities, how to evaluate risk conservatively, and how to execute decisions without emotional influence. The chapter also highlights Buffett's personal frugality during this time. He lived modestly, saved aggressively, and reinvested nearly everything he earned. This behavior wasn't symbolic. It reflected his long-term mindset and belief that capital compounds only when preserved and redeployed. By the end of Chapter 4, Buffett had built the foundation of his professional identity: a disciplined analyst, a devoted student of Graham's principles, and an investor who preferred rational calculation over speculation. This chapter marks the true beginning of Buffett as a practitioner, not just a student, of value investing. Chapter 5 details Warren Buffett's return to Omaha and the creation of the Buffett Partnership, the investment vehicle that established his reputation and set the foundation for Berkshire Hathaway. After Graham retired and the Graham-Newman firm dissolved, Buffett moved back home in 1956 with a clear plan to run money independently. Using the disciplined value investing framework he had learned, Buffett started small. He formed his first partnership with 7 limited partners, mostly family and close acquaintances, contributing a total of $105,000, while Buffett himself invested only $100. Lowenstein emphasizes how Buffett structured the partnership to ensure aligned incentives. Partners received profits above a 6% annual hurdle, while Buffett received a percentage of excess gains. Losses, however, affected Buffett more than his partners, reinforcing his cautious, risk-averse approach. The chapter explains Buffett's analytical workflow during this period. He spent long hours researching obscure and undervalued companies, focusing on special situations, workouts, and statistically cheap stocks. Buffett avoided market forecasts, ignored economic predictions, and instead centered every decision on intrinsic value. His process was quiet, methodical, and highly independent, far removed from Wall Street behavior. Buffett's early results were exceptional. Year after year, he outperformed the market, and the partnership quickly expanded as new partners joined. Lowenstein highlights Buffett's disciplined temperament. He refused to act unless a clear margin of safety existed, and he avoided sectors he didn't understand. His ability to remain unemotional, even when markets behaved irrationally, became a core competitive advantage. By the end of Chapter 5, Buffett had evolved from an analyst into a professional money manager with a scalable investment model. The partnership structure, combined with Buffett's research-driven strategy, positioned him for the major acquisitions and strategic moves that would define the next stages of his career. Chapter 6 examines Warren Buffett's investment performance. During the speculative go-go market of the 1960s, a period defined by aggressive trading, rapid capital flows, and a growing appetite for high-flying growth stocks, while most investors were drawn into momentum-driven strategies, Buffett maintained a disciplined, value-focused approach that sharply contrasted with market behavior. Lowenstein describes this era as one where institutional investors increasingly dominated trading volume, fueling a mentality that price momentum mattered more than business fundamentals. Mutual funds and professional managers chased glamour stocks, often paying extreme multiples for companies with unproven durability. Buffett viewed this environment as unsustainable. His partnership avoided fashionable sectors and refused to participate in speculative trends. Instead, Buffett directed his capital toward neglected companies trading below intrinsic value, often in industries or segments the market considered unexciting. Buffett's contrarian stance paid off. While go-go investors achieved short-term gains but suffered large volatility, The Buffett Partnership delivered consistent, superior performance with controlled risk. Lowenstein highlights Buffett's refusal to be influenced by market narratives. He ignored predictions, avoided macroeconomic speculation, and focused entirely on business economics and valuation gaps. The chapter also notes that Buffett began building larger positions in a few companies as his confidence in understanding their fundamentals increased. This selective concentration, combined with rigorous analysis, allowed him to exploit inefficiencies that speculative traders overlooked. His patience and independence became distinguishing advantages during a period dominated by herd behavior. By the end of Chapter 6, the reader sees Buffett's philosophy solidifying. Success comes from rational discipline, not market excitement. The go-go era validated his long-term strategy and reinforced his belief that speculative surges eventually collapse, while intrinsic value remains the anchor for sustainable returns. Chapter 7 explains how Warren Buffett acquired Berkshire Hathaway and how the company transitioned from a failing textile mill into the early structure of what would become his long-term investment vehicle. Lowenstein emphasizes that Berkshire was not initially intended to be the centerpiece of Buffett's empire. It was simply a Graham-style value play. Berkshire Hathaway in the early 1960s was a struggling New England textile manufacturer with shrinking margins and outdated operations. The stock traded at a deep discount to its working capital and liquid assets, which made it attractive to Buffett under his partnership's intrinsic value framework. He began purchasing shares gradually, viewing Berkshire primarily as a classic cigar but investment one last profitable puff left before decline. Buffett's relationship with Berkshire changed after a disagreement with management. Feeling the company was acting against shareholder interests, Buffett accelerated his buying until he gained control in 1965. Lowenstein notes that this decision, more emotional than analytical, marked one of the rare moments when Buffett deviated from pure rational calculation. Once in control, Buffett faced a challenge. The textile business continued to erode. Rather than rely on the operating company for growth, he redirected Berkshire's capital into more productive assets. This marked the beginning of Berkshire as a holding company rather than a manufacturing firm. Buffett used Berkshire's cash flow to acquire insurance businesses, whose float later became central to his compounding strategy. The chapter highlights the strategic insight behind this shift. Buffett realized that redeploying capital from failing operations into higher return investments was far more important than trying to revive a declining industry. By the end of Chapter 7, Berkshire Hathaway had transformed from a failing textile mill into Buffett's platform for long-term capital allocation, a turning point that shaped the trajectory of his investment career. Chapter 8 focuses on Warren Buffett's reintegration into Omaha as his permanent home base, and how this physical and cultural distance from Wall Street shaped his investing philosophy. After taking control of Berkshire Hathaway, Buffett settled fully back into Omaha, embracing its quiet, stable environment. Lowenstein explains that Buffett's choice to operate from a Midwestern city, not the financial centers of New York or Boston, was strategic. It insulated him from market noise and allowed him to think independently, free from industry trends and herd behavior. During this period, Buffett's role expanded beyond analyst and partnership manager. He increasingly acted as a capital allocator for Berkshire. Although the textile operations continued to decline, Buffett maintained a disciplined approach. He refused to pour capital into a business with structurally low returns. Instead, he directed surplus cash toward more productive investments, especially insurance, banks, and media companies. The chapter also highlights Buffett's growing public profile within Omaha. His partnership's strong performance attracted local investors, and Buffett became viewed as a financial authority in his community. However, his personal lifestyle remained modest. Lowenstein uses this contrast to emphasize Buffett's consistency. His focus remained entirely on research, valuation, and long-term decision-making rather than reputation or extravagance. A key theme is Buffett's growing emphasis on management quality. He sought businesses run by honest, competent leaders, people he trusted with capital. This shift shows Buffett beginning to move beyond the pure Graham model of cheap stocks toward a hybrid approach that valued durable businesses and strong managers. By the end of Chapter 8, Buffett had transitioned into a more mature phase, an investor operating from Omaha, with a distinctive philosophy, using Berkshire as a flexible capital vehicle and relying increasingly on judgment, discipline, and independence. Chapter 9 focuses on Warren Buffett's partnership with Charlie Munger and how their shared thinking reshaped Buffett's investment philosophy. Lowenstein presents Munger as the alter ego who expanded Buffett's intellectual range, pushing him to move beyond the traditional Graham approach of buying statistically cheap companies. Munger, a fellow Omaha native but trained as a lawyer, brought a broader, more qualitative mindset. He argued that buying a wonderful business at a fair price often produced better long-term results than buying mediocre businesses at bargain prices. This idea challenged Buffett's deep-rooted Graham discipline, which prioritized numerical undervaluation. Lowenstein emphasizes that Munger helped Buffett refine, not abandon, value investing by incorporating assessments of business quality, competitive advantage, and long-term durability. During this phase, Buffett increasingly sought companies with strong brands, competent management, and structural advantages. He became more willing to pay higher prices if the business demonstrated consistent earning power. The See's Candies acquisition, which is introduced in this chapter's context, became a practical example. Buffett realized the power of businesses that could raise prices without losing customers, a quality absent in most cigar butt opportunities. The chapter also highlights the personal dynamics between Buffett and Munger. Their conversations blended rational analysis, humor, and intellectual rigor. Munger served as a sounding board who challenged assumptions and reinforced long-term thinking. Buffett valued this partnership because Munger helped him clarify ideas and avoid narrow interpretations of value. Lowenstein explains that Buffett's evolution toward quality investing marked a major turning point. It positioned Berkshire to acquire high-return businesses instead of relying solely on asset-based bargains. This shift expanded Berkshire's compounding potential and shaped its future identity as a conglomerate built on durable, cash-generating companies. By the end of Chapter 9, the reader sees how Munger's influence strengthened Buffett's philosophy, making it more flexible, strategic, and focused on long-term business economics. Chapter 10 covers Warren Buffett's increasing involvement in national policy discussions during the 1970s and how his financial views intersected with political and economic developments. In Washington, Lowenstein emphasizes that Buffett was not a conventional political actor. Instead, he entered policy conversations as a rational capitalist concerned with economic fundamentals, taxation, and long-term incentives. This chapter explains Buffett's stance on several public issues, particularly taxation. Buffett argued that capital gains taxes should not penalize long-term investment, and that excessive taxation could discourage productive capital allocation. Lowenstein notes that although Buffett identified as fiscally conservative, he was not aligned with any political faction. His positions focused on economic logic rather than ideology. During this period, Buffett also became more publicly recognized as a financial authority. Policymakers sought his views on market behavior, inflation, and government spending. Lowenstein highlights that Buffett's insights were grounded in business fundamentals. He viewed inflation as a silent destroyer of capital and warned that companies without pricing power would suffer long-term earnings erosion. The chapter also details Buffett's skepticism toward Washington's attempts to fine-tune the economy. He believed that markets were inherently difficult to predict and that government policies often created distortions rather than solutions. This perspective reflected his broader investment philosophy: ignore macroeconomic forecasts, focus on intrinsic value, and avoid decisions driven by political noise. At the same time, Buffett's role in public discussions raised his national profile. While he remained rooted in Omaha, his ability to explain complex financial concepts in simple, rational terms made him a respected figure in policy circles. By the end of Chapter 10, Buffett emerges as an investor whose clarity of thought extended beyond markets into national economic debate. His Washington involvement reinforced the principles he applied in investing: discipline, skepticism of trends, and focus on long-term economics over short-term reactions. Chapter 11 examines Warren Buffett's growing involvement in the newspaper industry, particularly his investment in the Washington Post Company, and how this move highlighted his evolving focus on durable, high-quality businesses. Lowenstein presents this chapter as a case study of Buffett's shift toward companies with strong competitive advantages and sustained pricing power. During the early 1970s, the Washington Post faced declining investor confidence due to political pressures surrounding the Nixon administration and uncertainties from the Pentagon Papers controversy. Despite these concerns, Buffett viewed the company as significantly undervalued relative to its intrinsic worth. Lowenstein explains that Buffett's analysis centered on the Post's dominant market position, its strong brand, and its exceptional long-term economics factors that short-term traders were ignoring. Buffett built a close professional relationship with Katharine Graham, the Post's publisher. He admired her integrity, managerial discipline, and willingness to confront difficult decisions. Their partnership became one of the most important business relationships in Buffett's career. Lowenstein notes that Buffett acted as both an investor and an informal advisor, helping Graham navigate complex financial and governance issues. The investment proved highly successful. The Post stock eventually multiplied in value, reinforcing Buffett's confidence in focusing on companies with durable competitive structures, rather than relying solely on statistical bargains. This chapter highlights the maturing of Buffett's philosophy. He increasingly prioritized strong management teams, consistent earnings power, and industries protected by natural barriers to entry. The Press Lord chapter also demonstrates how Buffett avoided the typical investor bias toward short-term news cycles. Instead of reacting to political volatility, he evaluated the Post as a long-term business with stable economics. This disciplined approach allowed him to capitalize on temporary market mispricing. By the end of Chapter 11, Buffett emerges as a strategic investor who recognized the power of brand, managerial quality, and industry structure principles that later shaped Berkshire's major acquisitions. Chapter 12 revisits Warren Buffett's partnership years and explains how the structure and performance of the Buffett Partnership influenced his later decisions at Berkshire Hathaway. Lowenstein uses this chapter to show the continuity between Buffett's early investment style and the capital allocation approach he later applied on a much larger scale. The chapter reviews Buffett's core principles during the partnership era: investing only when odds were favorable, avoiding speculation, maintaining strict valuation discipline, and refusing to forecast macroeconomic trends. Lowenstein highlights that Buffett's track record during this period was exceptional. Through the 1960s, the partnership consistently outperformed the market, often by wide margins. Despite operating outside Wall Street and avoiding popular go-go stocks. But the chapter also explains why Buffett shut down the partnership in 1969. Turbulent market conditions, rising speculation, and the scarcity of attractively priced opportunities led Buffett to conclude that he could no longer invest partner capital with the same confidence. Rather than compromise his standards, he liquidated the partnership and returned capital to investors, an unusual act that underscored his commitment to rational decision-making. Lowenstein then connects this decision to Buffett's developing strategy at Berkshire. When the partnership ended, several assets, including Berkshire Hathaway itself, became part of Buffett's personal holdings. This shift marked the beginning of Buffett managing capital through Berkshire, rather than through limited partnerships. It also gave him more flexibility, with no formal fee structure and no external pressure to generate rapid returns. Buffett could take longer-term positions and make larger allocations to businesses he understood deeply. By the end of Chapter 12, Buffett's discipline, independence, and refusal to chase speculative trends stand out as the traits that allowed him to transition smoothly from partnership manager to long-term owner of a conglomerate built on rational capital allocation. Chapter 13 centers on Buffett's acquisition of Associated Cotton Shops and his interactions with its leader, Rose the Carpet Woman Blunken, founder of Nebraska Furniture Mart and FM. This chapter illustrates Buffett's growing focus on exceptional managers and how he increasingly used Berkshire Hathaway to acquire companies built on integrity, operational excellence, and strong local dominance. Rose Blumkin, known as Mrs. B, was a Russian immigrant who built an FM from a pawn-shop-size operation into one of the most successful furniture retailers in the United States. Lowenstein describes her as frugal, relentless, and intensely customer-focused. Despite minimal formal education and no corporate background, she operated with remarkable business discipline qualities that Buffett deeply admired. Buffett first visited an FM after hearing about its unusually low prices and extraordinary sales volume. He quickly realized that Mrs. B had created a durable competitive advantage through simple but powerful principles. Undercut competitors, run a lean cost structure, focus obsessively on customers, and manage inventory with precision. The store lacked corporate polish, but it generated outstanding financial results. Buffett purchased an FM for Berkshire with minimal negotiation, largely because he trusted Mrs. B's honesty and operational skill. Lowenstein emphasizes that Buffett considered her one of the greatest business minds he had ever met. The acquisition demonstrated Buffett's evolving investment philosophy. Instead of buying only undervalued assets, he sought high-quality businesses run by world-class operators. The chapter also highlights Buffett's respect for decentralized management. He let Mrs. B continue running an FM without interference, reinforcing his belief that talented managers perform best with autonomy rather than oversight. By the end of Chapter 13, the lesson is clear. Buffett increasingly recognized that exceptional people create exceptional businesses. An FM became a model for future Berkshire acquisitions focused on integrity, operational efficiency, and long-term value creation. Chapter 14 examines Warren Buffett's strategic evolution during the 1980s, a decade marked by economic volatility, deregulation, inflation concerns, and an increasingly competitive corporate landscape. Lowenstein shows how Buffett navigated this environment by sharpening his focus on high-return businesses, disciplined capital allocation, and the growing use of insurance float to fuel Berkshire Hathaway's compounding engine. The 1980s presented challenges for many companies, but Berkshire entered the decade with strong cash flow and a conservative balance sheet. Buffett used this position to expand selectively into industries with durable economics. Lowenstein highlights Berkshire's continued growth in insurance operations, including Geico and other subsidiaries, which produced expanding float at low cost. This float served as investable capital that Buffett deployed into stocks and whole company acquisitions. The chapter details several major equity investments, such as American Express and Capital Cities, ABC. Buffett favored companies with strong brands, efficient management, and predictable long-term earnings. These investments reflected the maturing of his philosophy. Quality and competitive advantage mattered as much as valuation. The decade demonstrated that Buffett was no longer simply a practitioner of Graham's asset-based approach. He had fully embraced an owner-oriented business quality framework. Lowenstein also notes Buffett's growing public influence. As Berkshire's results gained national attention, investors and analysts increasingly looked to Buffett for guidance on issues such as inflation, market speculation, and corporate governance. Despite this visibility, Buffett maintained a disciplined investment approach, avoiding sectors he did not understand and staying clear of the highly leveraged buyout boom. Characterizing the decade, by the end of Chapter 14, Buffett had positioned Berkshire as a diversified, resilient conglomerate with significant earning power and a long-term strategic edge. The 1980s solidified his reputation not only as a superior stock picker, but as a master capital allocator who used conservative principles to generate extraordinary compounding. Chapter 15 analyzes the dual nature of Warren Buffett's life during the period when his public visibility as an investor increased sharply, while he simultaneously worked to maintain a private, disciplined lifestyle in Omaha. Lowenstein uses this chapter to illustrate the contrast between Buffett's growing influence in the financial world and his personal preference for simplicity and routine. On the public side, Buffett's investment decisions both in stocks and in acquisitions drew national attention. Berkshire Hathaway's annual shareholder letters became widely studied for their clarity, rationality, and educational value. Lowenstein highlights that Buffett disliked the idea of being seen as a market guru, yet his commentary on inflation, market cycles, and corporate behavior increasingly shaped public discussion. This growing visibility brought him into more interactions with journalists, analysts, and policymakers. At the same time, Buffett continued to live a highly private and predictable life. His routines remained unchanged: simple meals, modest spending, and long hours reading reports and analyzing businesses. Lowenstein uses this contrast to show that Buffett's temperament, calm, detached, and focused on fundamentals, was one of his greatest competitive advantages. Public recognition did not influence his investment process. He avoided distractions and refused to make decisions based on reputation or external pressure. The chapter also covers Buffett's relationship with Berkshire shareholders. He emphasized transparency but discouraged short-term traders. Buffett wanted owners who understood his long-term framework and avoided those expecting rapid gains. This approach shaped Berkshire's culture and insulated it from market-driven expectations. By the end of Chapter 15, the reader sees a clear pattern. Buffett's success stemmed not just from analytical skill, but from maintaining a strict separation between public attention and private decision-making. His ability to stay grounded, disciplined, and insulated from market noise allowed him to preserve the rational mindset that defined his investment philosophy. Chapter 16 covers Warren Buffett's perspective and actions during the 1987 stock market crash, a defining moment that demonstrated his discipline, risk management, and independence from market psychology. Lowenstein uses this chapter to show how Buffett navigated extreme volatility with the same long-term mindset that guided his broader investment philosophy. The October 19, 1987 crash, when the market fell more than 20% in a single day, caught most investors by surprise. Panic spread across Wall Street as portfolio insurance strategies failed, and forced selling accelerated the downturn. Lowenstein emphasizes that Buffett did not participate in the defensive tactics that dominated institutional behavior. He viewed portfolio insurance and rapid trading as forms of speculative engineering, disconnected from business fundamentals. Instead of reacting emotionally, Buffett saw the crash as a temporary dislocation in prices rather than a change in the value of underlying businesses. He focused on the stability of Berkshire's holdings, the strength of its insurance operations, and the long-term earnings power of its major investments. Buffett maintained that if companies retained their competitive advantages and continued generating cash, market volatility had no effect on intrinsic value. The chapter also highlights Buffett's behavior during the crisis. He spent the day reading and analyzing rather than trading. He did not attempt to time the market or predict further declines. This calm approach contrasted sharply with the panic selling happening nationwide. Lowenstein uses this moment to illustrate Buffett's temperament, his ability to detach from crowd behavior and rely on valuation-based judgment. The crash reaffirmed several principles: avoid leverage, ignore market forecasts, and hold businesses with durable economics. By the end of Chapter 16, Buffett's resilience during the 1987 crisis reinforces why his long-term discipline consistently outperforms strategies driven by emotion or short-term modeling. Chapter 17 uses the metaphor of throwing darts to illustrate the randomness and unpredictability of short-term market behavior. Lowenstein contrasts this randomness with Warren Buffett's disciplined investment philosophy, showing how Buffett deliberately avoids strategies that depend on forecasting or luck. The chapter discusses the surge in academic interest in market efficiency. During the late 20th century, many economists argued that stock prices reflected all available information, making it nearly impossible to outperform the market consistently. This view likened stock selection to throwing darts at a board. Results were assumed to be largely random. Lowenstein explains that while Buffett respected rigorous analysis, he rejected the idea that markets were perfectly efficient. His investment record demonstrated that mispricing did occur, especially in less followed companies or during periods of emotional trading. Buffett's approach, built on intrinsic value and long-term economics, stood in sharp contrast to strategies dependent on statistical models or market timing. He believed that investors who relied on forecasts were effectively throwing darts blindly. Instead, Buffett focused on understanding businesses deeply enough to recognize when market prices diverged meaningfully from business value. Lowenstein also highlights how Buffett distinguished between risk and volatility. While the market might fluctuate unpredictably, true risk was the possibility of permanent capital loss, not temporary price movements. This concept set Buffett apart from academics and portfolio managers who equated volatility with risk. The chapter emphasizes Buffett's skepticism toward Wall Street's growing fascination with quantitative techniques and rapid trading. He viewed many of these models as fragile because they ignored fundamental business realities. By the end of chapter 17, the takeaway is clear. Buffett's success comes from rejecting the dart-throwing mentality and focusing instead on patient evaluation of real businesses. His philosophy underscores that markets may be noisy in the short run, but sound analysis and discipline can systematically exploit long-term inefficiencies. Chapter 18 examines Warren Buffett's perspective on the role of the Federal Reserve and monetary policy, focusing especially on how interest rates and inflation shape long-term business value. Lowenstein uses this chapter to highlight Buffett's pragmatic understanding of macroeconomic forces. Even though Buffett famously avoids making investment decisions based on economic forecasts, the chapter's title refers to the Federal Reserve as the temple, a powerful but often opaque institution influencing the financial system. Lowenstein explains that Buffett, while not a macro strategist, understood the Fed's policies deeply because of their direct impact on valuations. High interest rates raise the discount rate applied to future cash flows, reducing the intrinsic value of businesses. For Buffett, this meant that periods of tight monetary policy required even more discipline in selecting investments. During the late 1970s and early 1980s, the Fed's aggressive stance against inflation led to historically high interest rates. Many companies struggled under high borrowing costs, and asset values fluctuated sharply. Buffett recognized that businesses lacking pricing power or carrying heavy debt were especially vulnerable. This reinforced his preference for companies with durable competitive advantages, strong balance sheets, and the ability to raise prices without losing customers. Lowenstein also highlights Buffett's skepticism toward policies that attempted to fine-tune the economy. Buffett believed that long-term business fundamentals mattered far more than short-term monetary adjustments. While acknowledging the Fed's influence, he avoided making investment decisions based on predictions about rate changes. Instead, he focused on buying companies whose economics could withstand various monetary environments. The chapter concludes by showing that Buffett's understanding of the Fed was practical rather than speculative. He respected the institution's power, but refused to let macroeconomic noise override rational valuation. This disciplined separation between economic awareness and investment decision-making became a defining strength of Buffett's approach. Chapter 19 uses the story of Howie Buffett, Warren Buffett's son, to illustrate themes involving personal values, family independence, and the contrast between agricultural economics and Berkshire Hathaway's corporate model. Lowenstein shifts the focus from Warren's investment activities to the broader Buffett family dynamic, showing how Warren's principles shaped not only his business decisions, but also his expectations for his children. Howie Buffett chose a path very different from his father's by becoming a farmer. Lowenstein explains that Warren respected, perhaps even preferred, this independence. He wanted his children to develop their own identities rather than rely on his wealth or influence. Farming, in this context, symbolized a lifestyle built on hard work, self-reliance, and economic pragmatism. These were values Warren himself believed in, even though his own career led him in a completely different direction. The chapter also uses farming economics to draw parallels with Warren's investment philosophy. Agricultural markets are highly competitive, sensitive to commodity prices, and driven by long-term cycles. They reward efficiency and discipline, but offer little protection from volatility. Lowenstein highlights that Warren often referenced these characteristics when discussing business fundamentals, without competitive advantage or pricing power. Even the hardest-working operators face economic limitations. Through Howie's story, Lowenstein reinforces Warren's belief that wealth should not distort incentives or create dependency. Warren did not plan to leave vast fortunes to his children. Instead, he emphasized education, responsibility, and personal agency. His approach to family mirrored his approach to business: avoid complacency, maintain discipline, and make decisions grounded in long-term fundamentals. By the end of Chapter 19, the themes converge. Howie's farming life provides a practical backdrop to illustrate Warren's broader worldview about work, economics, independence, and the limits of industries without intrinsic competitive advantages. Chapter 20 explores Warren Buffett's approach to risk, specifically his aversion to excessive leverage and financial fragility, what Lowenstein calls rhinophobia, the fear of financial disasters that can trample even strong companies. The chapter highlights Buffett's deep skepticism toward debt-driven strategies, speculative financial products, and corporate decisions that prioritize short-term gains at the expense of long-term stability. Lowenstein explains that Buffett viewed financial risk as something that must be controlled through structural discipline rather than optimism. Buffett believed that companies with high leverage were vulnerable to unexpected shocks: economic recessions, interest rate spikes, or operational missteps. Even seemingly strong firms could be undone quickly if their balance sheets lacked resilience. This mindset aligned closely with his core investment principle: avoid situations where permanent capital loss is possible, regardless of potential upside. The chapter discusses how Berkshire Hathaway applied this risk framework. Buffett ensured that Berkshire maintained substantial liquidity, minimal reliance on debt, and a diversified set of cash-generating businesses. Insurance float, one of Berkshire's most important funding sources, was managed conservatively to avoid pressures during market downturns. Lowenstein contrasts Berkshire's cautious structure with the more aggressive financial engineering practices spreading across corporate America. During this period, Buffett's rhinophobia also extended to investment decisions. He avoided companies dependent on unpredictable markets or cyclical pricing, and he rejected firms that relied on leveraged buyouts or debt-fueled expansions. He preferred businesses with strong competitive advantages, reliable cash flow, and management teams that avoided risky financial behavior. By the end of Chapter 20, the key message is clear. Buffett's long-term success is inseparable from his disciplined risk aversion. His fear of financial fragility, far from being a limitation, served as a strategic advantage, enabling Berkshire to survive market shocks and capitalize on opportunities when over-leveraged competitors stumbled. Chapter 21 examines Warren Buffett's rise to a near-mythic status in American finance and how his investment success during the late 1980s and early 1990s positioned him as an unparalleled figure, essentially the king of rational capital allocation. Lowenstein shows that this recognition was not built on publicity or self-promotion, but on sustained performance, consistency, and Buffett's reputation for integrity. During this period, Berkshire Hathaway's book value and market value accelerated dramatically as its major holdings, such as GEICO, Capital Cities, ABC, Coca-Cola, and the Washington Post, produced strong results. Buffett's increasing concentration in high-quality businesses, supported by growing insurance float, created a compounding engine unmatched in corporate America. Lowenstein highlights that Buffett's investment in Coca-Cola, in particular, became a defining example of his evolved philosophy. Buy dominant global brands with durable economics and let time do the heavy lifting. The chapter also explains how Buffett became a public symbol of disciplined investing. Reporters, analysts, and even CEOs viewed him as the standard for rational decision-making. Yet Buffett remained focused on fundamentals, reading, valuation analysis, and selecting managerially sound companies. He showed little interest in status, luxury, or Wall Street trends, which reinforced his credibility. Lowenstein contrasts Buffett's approach with the growing excesses of the financial world: leveraged buyouts, short-term speculation, and executive compensation practices disconnected from performance. Amid these trends, Buffett's straightforward methodology stood out: avoid leverage, invest in what you understand, and partner with ethical managers. By the end of Chapter 21, Buffett's position as the king is not about celebrity. It is about mastery. He earned influence because his results, methods, and long-term focus consistently outperformed the market and exposed flaws in conventional financial behavior. The chapter frames Buffett as the dominant figure of modern American capitalism, respected not only for wealth, but for the clarity and integrity of his investment philosophy. Chapter 22 details Warren Buffett's role in the Salomon Brothers scandal of 1991, one of the most serious crises he ever faced as an executive. Lowenstein uses this chapter to illustrate Buffett's leadership style under pressure, his commitment to ethical conduct, and his ability to stabilize a collapsing financial institution through credibility, rather than technical expertise. The crisis began when Salomon traders were discovered to have repeatedly violated Treasury auction rules, submitting illegal bids to corner the market. When the scandal became public, Salomon faced the possibility of criminal prosecution, massive fines, and a ban from bidding in Treasury auctions, an outcome that would have effectively destroyed the firm. As Berkshire Hathaway was one of Salomon's largest shareholders, Buffett was thrust into the center of the crisis. Lowenstein explains that Buffett stepped in as interim chairman, even though he had no background in investment banking operations. His immediate priority was to restore trust. Buffett traveled to Washington, testified before Congress, and was fully transparent about the misconduct. His straightforward approach contrasted sharply with Wall Street's typical defensiveness. Buffett emphasized accountability, stating the now famous line, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." Internally, Buffett worked to stabilize morale, enforce strict compliance, and maintain liquidity during a period of intense scrutiny. Externally, his integrity persuaded regulators to avoid shutting down the firm. Lowenstein makes clear that it was Buffett's personal credibility, not Salomon's financial strength, that saved the company. By the end of Chapter 22, Buffett's handling of the crisis reinforces the core principles that define his career: discipline, transparency, ethical consistency, and the belief that reputation is an investor's most valuable asset. The Salomon episode demonstrated that Buffett's leadership extended far beyond investing into crisis management and corporate governance at the highest level. Chapter 23 explores Warren Buffett's increasingly structured routine, his disciplined lifestyle in Omaha, and how these habits supported his long-term success as an investor. Lowenstein uses Buffett's trolley as a metaphor for Buffett's predictable, almost mechanical approach to daily life, an approach that minimized distractions and maximized mental focus on business analysis. The chapter begins by describing Buffett's regular commute and simple routines. Despite being one of the wealthiest individuals in America, Buffett maintained modest habits, the same house, the same routes, and the same daily processes. Lowenstein emphasizes that this consistency was intentional. Buffett believed that reducing decision fatigue allowed him to conserve mental energy for high-quality thinking and business evaluation. Professionally, this period reflects Buffett's role as a full-scale capital allocator. Berkshire Hathaway had evolved into a conglomerate with numerous subsidiaries, growing insurance float, and substantial equity holdings. Buffett spent most of his time reading financial statements, evaluating acquisition candidates, and communicating with managers of Berkshire-owned companies. His trolley-like routine created stability within Berkshire's decentralized structure. The chapter also highlights Buffett's increasing reliance on trusted managers. He avoided micromanaging operations and instead selected leaders who ran their businesses autonomously. Buffett focused on allocating capital at the top level, while ensuring that Berkshire's culture remained grounded in integrity, rationality, and long-term thinking. Lowenstein contrasts Buffett's predictable lifestyle with the volatility of the financial world. While markets fluctuated and corporate America embraced aggressive debt, rapid mergers, and short-term earnings goals, Buffett remained committed to patience, conservative financing, and intrinsic value. By the end of Chapter 23, Buffett's trolley symbolize is more than routine. It represents Buffett's foundational belief That success is built on discipline, consistency, and focus. His ability to maintain a steady, rational process in an unpredictable environment solidified Berkshire's identity and set the stage for Buffett's continued growth as America's most respected capital allocator. Buffett, the making of an American capitalist, traces the development of Warren Buffett's investment philosophy, business evolution, and personal principles across more than 5 decades. The book shows that Buffett's success did not come from secrets or shortcuts, but from a consistent framework built on patience, discipline, and rational decision-making. The story begins in Omaha during the Great Depression, where Buffett learned the value of thrift, independence, and numerical thinking. His early fascination with business paper routes, pinball machines, stock charts showed a mindset deeply focused on efficiency and compounding. This foundation strengthened when he discovered Benjamin Graham's value investing philosophy, which taught him to evaluate stocks as businesses and to invest only when a clear margin of safety existed. Buffett's years at Graham Newman refined his analytical skills, but his return to Omaha and the launch of the Buffett Partnership marked the first major phase of applying value investing at scale. During the speculative go-go era of the 1960s, Buffett's contrarian discipline allowed him to outperform without following market fads. His eventual takeover of Berkshire Hathaway, originally a failing textile operation, became the platform for his long-term strategy: redeploy capital from low-return businesses into high-quality assets and insurance operations that generated float. Throughout the 1970s and 1980s, Buffett's philosophy matured under the influence of Charlie Munger. Instead of focusing solely on cheap stocks, Buffett began prioritizing durable competitive advantages, strong brands, and exceptional management teams. Investments in companies like the Washington Post, GICO, and Coca-Cola illustrate this evolution. Berkshire's decentralized structure allowed managers to operate independently, while Buffett focused on capital allocation and long-term economics. The book also highlights Buffett's leadership during crises, especially the Salomon Brothers scandal, when his integrity and transparency stabilized a firm on the brink of collapse. His actions demonstrated that reputation and trust are essential components of long-term business success. As Buffett's public profile grew, he maintained a private, disciplined lifestyle rooted in routine, reading, and rational analysis. His preference for simplicity both in life and in business contrasted sharply with Wall Street's obsession with complexity and short-term results. By the 1990s, Buffett had become the symbol of patient, fundamentals-based investing, proving that exceptional returns are possible without speculation, leverage, or prediction. Ultimately, the book portrays Buffett as a long-term strategist whose advantage comes from temperament, not just intelligence. His ability to ignore market noise, evaluate businesses objectively, and allocate capital with discipline transformed Berkshire Hathaway into one of the most successful companies in American history. If you found this breakdown helpful and you want more deep dive summaries of the world's most influential finance books, make sure you hit the like button. It really supports the channel. Subscribe for weekly insights on investing, money psychology, and wealth building strategies. Turn on notifications so you never miss a new summary. And tell me in the comments, which financial book should I cover next? Your next breakthrough might be one video away.